In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we have a great guest for you today. It's a gentleman who has applied his technological thinking to real estate investing, of course, to make it easier to find those great deals. But today's guest is Stefan Tsvetkov, and Stefan is the founder of RealtyQuant, a company that brings data-driven and quantitative techniques to the real estate industry on a mission to add massive industry value through education, investment, technology, and analytics. A financial engineer turned multifamily investor, analytics speaker, and live webinar host, he holds a master's degree in financial engineering from Columbia University, and during his finance career managed $90 billion in derivatives portfolio jointly with colleagues. Featured on multiple podcasts and webinar events, including Invest Up, Best Ever Real Estate Show, Discovering Multifamily, etc. He is the host of Finance Meets Real Estate webinar series. Well, Stefan, welcome to the Old Dogs REI Network.
Thanks for having me, Bill. Pleasure to be here.
Oh, well, it's great to have you on. It sounds like you have got some great stuff to share with us today. But before we jump into the nuts and bolts here, maybe you could just give us a little bit about your background.
Oh, yes, absolutely. So I'm Eastern European originally. So I came to the States at 22 for my master's. Like you mentioned, financial engineering. I had a career in finance for about a decade. And in the recent few years, I've been a multifamily investor. I live in New York City. I invest in the New York City area as well.
Oh, interesting. Now, how did you get involved in real estate investing? Now, it sound like you were on sort of the engineer track there.
Yeah, that's true. That was kind of unexpected for me as well. I purchased my first fourplex, owner-occupied fourplex, kind of like house hacking to some of your audience who are acquainted with bigger pockets, that discusses that. So I kind of lived in one unit, was living rent-free in a way, and I liked the unit very much. I happened to like the house, so I thought I liked it in terms of the returns, the leverage, and so forth. So I started. That's how I got into it, by purchasing a primary residence.
Now, was this in New York City?
This was in New Jersey, right by New York City, Hudson County, New Jersey.
Ah, okay. And you just started looking around, found a nice little fourplex, and decided to take the dive in the investment world, huh?
Yeah, pretty much. Kind of a mixed occupancy and investment dive, I guess. But yeah, it worked out well, and I was happy with it.
Oh, that's
I
great.
liked the asset from there.
And you were self-managing it too?
Yeah, I was owner-occupying and respectively self-managing, the other units, like calling repairmen and things like that. Pretty standard, really, in that sense.
Sure. And at some point, you decided to grow it at that point to get to acquire. Obviously, moving into multifamily. You were already in multifamily at the small multifamily, but decided to expand from there. Could you talk a little bit about that?
Yes, absolutely. Yeah. So from there, I kind of started, writing my own scripts and kind of like using data to discover like different deals. To your point, in the small multifamily space. So it would be like 3, 4, 5, 6 unit properties like that. And so I would kind of, I would just like write my scripts. I would pull like thousands of listings and kind of try to price them out on different criteria. Okay, what are the ones that have the best, the best cap rates, which ones have maybe some, some sort of discount to them potentially. A little bit, or which ones. Then I started looking into condominium conversions, which is what I've been doing in the area as well. So, sort of pulling data, having like good condo estimates, multifamily estimates, looking for some spread on that end. But essentially the approach was, okay, I have all the on-market and some off-market data. Can I utilize it and try to sort of trade the real estate market as we do in finance, in a way.
Gotcha. And so you took, sounds like probably tapped into MLS as well as off market. Did you get into sort of county records and that type of thing to find off market?
I did, yeah, absolutely, I did. In the residential space, and I really do this because I've been recently switching to the commercial entirely, to the commercial field entirely. And in the residential space, I would say that even on market, if one does it in this data-driven approach, one can find deals by simply pulling thousands of listings and looking at, let's say, the top 0.1% of them or something like that. So I had good success discovering deals that were undervalued, especially, in some certain, I would say, like for your audience, I would say in areas where, liquidity is a bit less, like, let's say like places like upstate New York, like deeper in New Jersey and things like that, speaking of my area over here. And so I was able to find like discounted deals where, yes, I would pull the county records. I would look at even like what the market value of the property is according to the tax authorities, sort of like the assessment times the equalization rate that the tax authority has. And, and I was able to find like discounted deals in that way. I had a deal that was like a non-warrantable condo building. So it was like a small condominium building, and I purchased it perfectly turnkey, and I had, like maybe 25% upside or so by simply recognizing that, okay, I can find financing for it. I can, I can find buyers that would be not overly concerned about the profile of it, etc. And so that was another strategy. And condominium conversions as well, fairly turnkey. I had a 4-plex residential, which I turned into a commercial 5-unit, and it sort of doubled the valuation. So it was really, my focus was always, okay, there's all the real estate players are kind of focusing on the renovation, the rehab aspects. If I look like around New York City, lots of the deals would be, like some of the hardest deals to purchase would be like a completely, like a gut rehab project, right? So if it's a gut rehab project, like within a day or something, there's going to be like 15 offers or something like that. And so I was thinking like, if instead I focus on where my advantage is, I could discover deals amongst more turnkey stuff. And really, like, that's pretty much what I did. So I really did largely turnkey or like sort of stabilized asset properties where I may improve them in addition, but it's kind of the inefficiency is there in as-is condition.
I see. So you were Now, were you flipping these properties or wholesaling them for the most part, or were you, buying them and tenanting them up and managing that way?
Not wholesaling, but yes, flipping on a sort of, not with maybe the greatest urgency of, that some flippers have, but with the idea, yes, to realize an equity gain on a period of, between 6 months to 2 years, generally like a 2 years hold, something like that. Yeah, definitely.
And I kind of like that strategy too. On the fourplex, yeah, obviously if you add one more unit to it, it becomes a commercial property. Did you have to add on, or did you use existing square footage to make that fifth unit?
Well, so to clarify again, like since I mentioned kind of like stabilized assets, so that was really all I did is I put like a smoke detector, and fire extinguisher in that unit. It was just a unit that it was in an extra efficiency studio apartment, and they just hadn't made it a legal unit. That's all.
Oh, okay. So just converting what was already there for the most part, right?
Yeah. So it was entirely a legal side, kind of, just calling up the town and working with the town officials to, let's make it a legal unit. And from there, okay, now it's commercial, go to the respective commercial lenders and, get the valuation. That's all. Yeah, it was really no renovation work.
Now, have you had to do a number of renovations on the properties you've acquired?
No. So like I said, I do cosmetic kind of renovations, but generally no. So I do seek equity gains. I do seek to flip them. But I tend to not kind of opt for the risk profile of extensive renovation.
Okay, so just you try to find it under market enough that you've already bought it at with equity, and then you just do some touch-ups just to maybe maximize the return.
That's correct. Yeah. I mean, purchased under market, or just because perhaps there can be a restructuring that can be done. Like the case with the fourplex to a 5-unit, or like the non-warrantable condominium building, or like taking a multifamily and converting it legally, splitting it into condominiums. So yeah, kind of like stabilized arbitrage strategies, I would call it, something like this. So that's pretty much what I did so far, like in the New York City area. But yeah, definitely. So far, no extensive renovation. No, it's always been fairly stabilized, and I've been able to realize an equity gain like that.
And how many properties have you done like this?
Seven. So far.
Got it. Just on the condo conversion, so you would take an existing condo building, how many units generally would that be?
Yeah, so the condo conversion, I mean, it can really apply to technically any number of units. But for what I was doing, it would be more like a 3-family, ideally, or 4.
Okay.
So, yeah.
And to convert that to a standard sort of small multi, what would be the difference on that?
No, it would start as a multifamily. It would start as
multifamily. Okay.
Yeah, so it would be, let's say it's a 3-family, and it costs maybe $800,000 or something like that. And then, try to make it into condominiums, perhaps do some renovation and try to raise it to, maybe if it's a great project, close to 1.2. I mean, considering that there's going to be some renovation cost to get this kind of nice condo values, let's say, but really looking for something where the inefficiency is there, even if one doesn't renovate. So it's kind of, let's say, the 3-family, if simply it is separated, I'm looking for a situation where the separated condition, kind of the parts are worth more than the whole, it sounds super simple, it sounds trivial, but they do it with data, because the reality is when I start pulling like what's of those condo conversion projects, the reality is that most of them would not meet those criteria. or simply there is a situation that condition is like really, kind of needs plenty of work. And when you look at, like the REO renovation work there, etc., or there isn't a genuine spread, it's more like just optics perhaps. So it does sound very, very simple once you have a project that works.
Right.
To find one actually takes some work, and typically I would go view them in person, and it's the 99% of things don't really work for that. But yeah, once it does, then it becomes fairly easy to implement, because on the conversions, at least in my area, I feel like are not so utilized by investors, and they seem to feel some uncertainty as to whether the conversion is going to happen. And then, well, the reality is, from speaking to attorneys, is conversions in themselves, like by themselves, are like nearly a certainty, in that there's no, there are no special requirements for that to happen, as long as, if you want to do it, as long as the multifamily is all compliant with all rules, etc., it's going to happen. So it's a fairly low risk kind of endeavor in comparison to other, kind of like land subdivisions and things like that, which are fairly complex.
Right.
Yeah.
Well, what's the difference between a condo and a multifamily? What do you have to do to that property to make it into a condo?
Right. I mean, it's just legal side work. So the legal side work is really setting up the HOA, like the condo association, what the HOA fee is going to be, like putting in the condo association like bylaws and I guess master deed, and what would be the different conditions and requirements for usage of the common area, how the common area is exactly separated. Things like that.
So you just do the paperwork and then basically sell it as a condo. You don't actually end up managing the HOA or anything of that.
Well, in the meantime, while the units are selling, you're sort of in a position of responsibility in terms of the HOA, but yeah, really with the goal to sell the units. Yeah.
Got it. Well, what's fascinating about this is, one, not so much, you buy some good properties, buy them under market in this inflated market, that you can do this. And I would assume it's because you've got this software that is just, data mining, data scraping, whatever you might be doing to give you these thousands of potential properties, and then presenting you with, and I guess you maybe generate a report or something where the sort of the best rises to the top, right?
Correct.
Now, are you doing this full time?
I am. Yeah. I'm doing it full time, and I also, like you mentioned at the beginning, I run a company called RealtyQuant, where it's sort of my mission is to build different data-driven tools, analytics for the real estate industry, to sort of help other investors and, help other people make better business decisions.
So someone could go to RealtyQuant.com and look at, in other words, sign up for the service and have access to thousands of, potential properties in their areas, not necessarily New York or New Jersey.
No, specifically so this kind of like deal search, you mean? The deal search, so that I'm actually currently putting in a product that is for lead generation. So if your question is in terms of lead generation, I'm just putting a product that should be out perhaps next week, which does commercial multifamily lead generation. And I can speak to that. That's actually a very interesting methodology there in terms of like finding, because that's entirely off market, and it's on the commercial side, but that's something that I'm putting as far as lead generation. I do not do the residential as a product in that sense. I teach a course, though. I teach a course on data-driven real estate investing with Python, where, people can learn, how to do it. And I can guide them, basically show them all my scripts. I show them how exactly I do it. I show them all my models for residential on market, commercial off market. I show them how to do automated valuation models, which is like Zillow's estimate, to price houses automatically. I show them different components of automated underwriting, for example, condition scoring. Condition scoring is a very interesting technology. There is a company in New York called Foxy AI. I'm not associated with them. They seem to be the leader in property condition scoring, which means on the visual side, which means like taking in images and processing, like kind of giving a score of what the condition to those images is. Let's say it's a 1 if it's a perfect condition, 5 if it's it needs complete renovation, for example. So that and that's done via on the textual side, it's done via natural language processing models. So that's one thing also I teach in that course. And on the visual side, it's really computer vision models. So it's really machine learning applications. But the end goal is, okay, what's holding us from automated underwriting? If we want to underwrite, at least in a preliminary sense, it's not to say that, we're going to rely on this in a way that's going to increase our risk or something. No, it's more like in a preliminary sense, if you want to underwrite thousands of either residential or commercial properties, what's holding us from really doing that so that we don't have to hire extensive teams to do it for us? It's, condition, visuals, reading images, reading textual descriptions is a big factor. So those are those are some things I talk about there, and a little bit of blockchain as well, like a little bit like real estate tokenization, like how to set up your own kind of security token. It's kind of like how to write up your code and publish it on the blockchain, on the Ethereum network or other network.
Oh, great. So would you say that people that would use RealtyQuant, they'd have to have some sort of technical background?
Well, for the course, yes, the course is a little technical, I agree. I've looked into, only for the course. So I've looked into kind of making it with more like no-code tools. I'm still working on that to make it more accessible to a broader audience. So that is my kind of next phase and like next steps. But the current one is it's a little bit geared towards somewhat technical folks or who may be willing to learn a little bit of Python. Since Python kind of has gained, it's more like indeed I would say the younger crowd in that sense, admittedly.
Sure.
Yes.
Python is the software that they would utilize, the programming software?
Yes, Python is the programming language that I utilize for that. But as far as other tools, like so one thing that we do at RealtyQuant is which would be very useful to also passive investors in your audience or active investors on the market selection side is. So I did studies, like regression-based studies of market valuation. So trying to gauge if different real estate markets are overvalued. And I have this for 2,700 US counties. And it's published at RealtyQuant.com. And it is really market data reports that it's a lifetime that one can subscribe to that are offer like a lifetime free updates, really. So once they join our email list, they will just be constantly, on a quarterly basis, that is, updated on where real estate markets in their state are going in terms of market valuation. And what I mean is, in the sense, if, for example, Atlanta, Georgia is fairly valued now, it would really be a subscription where they would get quarterly updates of how that's evolving over time, let's say now with inflation and so forth. So if, for example, if it's, if market valuation is, let's say, at 5%, slightly overvalued or fairly valued, they're able to actually track this as it evolves and see the full history and so forth. And this is a very statistical predictive measure, actually, which worked to predict the downturns post the global financial crisis in their magnitude to like very high correlation at the state level. And that's, some people get surprised at how to say, like this kind of finance theory and, being able to predict something. There is a lot of skepticism, I feel, but it's really to understand what's being predicted there is merely an overvalued component. It's not, there's no prediction as to timing. There's no prediction as to what exactly caused that overvaluation, be it, like the whole, let's say, like mortgage-backed securities development, before the global financial crisis or so forth. But all that it's doing is, real estate is a fundamental asset. It's driven by income, population, and housing supply. And what I've seen, at least in the data, is that deviations versus a moving average window of fundamentals, such as, let's say, 20 years and how fundamentals have been, and kind of this shifting with quarter by quarter shifting with time. And so deviation from that was highly correlated to the downturns post-global financial crisis. And so that is something that some of your audience may enjoy. I've got a lot of kind of traction and, interest in, is this real estate market overvalued, like things like that. And it's been like really very easy for me to build, like in terms of, it's not the most technical thing. It's really a linear regression, and you get, I don't know, I feel like I have benefited in my own investment process so much from it, because it's simply, something that tells me with some degree of certainty, some degree of confidence, whether the market that I'm investing is overvalued, and it just gives me a perspective of not worrying and, having business continuity. And it just makes you a competent investor on the market side. It's really what people like Warren Buffett were doing in the past. And if one thinks about it, the real estate is something like where in the stock market, it's so hard to predict valuation, right? The stock market is driven by the big 5 technology stocks in its changes currently. And so who knows what they're worth, right? It's complicated to know valuation on the stock market side. But if we had something in the stock market like the stocks of utilities companies, let's say, now that's not hard to predict. And that is pretty much our situation in real estate. So I feel extremely fortunate to work in this industry where, the analytics that I do actually work.
Now, how many do you zero in on key MSA areas? What geographic areas?
Oh, no, it's really, so this study, so it can be done at zip codes level as well. I've really done it for every U.S. county.
Every U.S. county? Wow. Okay.
Yeah. So I have it. So at RealtyQuant.com, there is like market valuations data for, close to 3,000 counties, basically. So it's really going to tell you, let's say the state of Indiana is, let's say, valued at, let's say, plus 2%. Just I'm making up the numbers. And then maybe Indianapolis and various other markets in Indiana. And it's proxied by the county level, but it has like all the cities and so forth, or let's say maybe a little bit more overvalued at 8% or something like that. So it's just going to give you like where valuations are, what price performance has been relative to those valuations. And it has some autocorrelation kind of momentum measures. It shows like autocorrelation, where autocorrelation is just like correlation of like, let's say, this year price performance versus last year price performance. It's just a measure of trend and momentum. And because many, on the appreciation side, because many U.S. markets are really autocorrelate. For example, the state of Florida, depending on data set, in like Federal Reserve Bank of St. Louis data set, had like about 77% autocorrelation, which is pretty high. So basically, like historical prices sort of predicting, future prices, but like 77% of last year performance, to be this year in terms of correlation. And so that's another thing that is there. But yeah, I feel the biggest value is really which markets are overvalued. And that worked pretty well, like I mentioned, for the global financial crisis. So the states that dropped the most at the time, which were Arizona, California, Nevada, and Florida, which dropped like 40-50%. Their valuation was in line with that. So they were like 40 to 60, depending on the data set, overvalued. And then the states which didn't drop at all, almost, or very little, which was, for example, the state of Texas at the time was 5% undervalued, and it only dropped 4%. And in fact, like 10 US states at the time which were undervalued, they dropped an average of 4% only. And the state of North Dakota dropped 0, in fact. It just basically stayed flat. And that was quite impressive. And I was trying to understand like what drove that. And then I had, because I have host a webinar, and I had Vinny Chopra at my webinar. And he shared I did my first multifamily syndication deal, and I purchased it in 2008. And it had this very high IRR, very high internal rate of return after this. And I was like, oh, okay. So apparently it was a very good project that he selected. But well, okay, that actually makes sense, because he purchased it in Texas, and it was a specific market in Texas, and it was, Texas was undervalued at the time. And so his property didn't decrease in value. It had no depreciation whatsoever after the global financial crisis. And so that was very interesting. And so I did a similar, kind of similar study now. And I have the similar data now, and it evolves, it keeps changing, Bill. It's quite different, since the second and third quarter of last year. It's quite different than it was before, because I used to, So I went to some events before, and I would say, okay, U.S. real estate is fairly valued. And that was consistent with other studies by other people, by the way. There is one done at more recently at Florida Atlantic University. And then there is a study by Bloomberg Economics by Niraj Shah is the name of the economist there. So the Bloomberg Economics study, they used to publish it since 2019. And the last they published it the first quarter of 2021. And they shared various countries being very overvalued, but U.S. being fairly valued. So they had Canada very overvalued, and Scandinavia, like countries in Scandinavia, and Australia, New Zealand, and a little bit, to some extent, the United Kingdom, to a lesser extent. But then U.S. was actually fairly valued. And that was kind of the intuition of most investors as well, where we didn't feel, okay, it's a crazy bubble or something like that. And so this nevertheless changed. And so I kept tracking. So the first time I started doing this was the beginning of COVID. So it was in March or like April of 2020. And the sheer reason to do it was I just wanted to understand like my downside risk as an investor. But when I did it, I computed the whole history of market valuations like back for like 45 years.
Wow.
And so it's really has really historical data to it. And that's at RealtyQuant.com. Like I said, that's all published, and, anyone can really get it. It's pretty cheap as well. And so I was even kind of like a little bit lazy to update some of those measures for my own usage initially, like before having it as a product, since I felt, it's always the same. So for example, the states of Florida and Texas were staying like for about 4 years. So between 2017 and 2021, they were in the 8 to 10% slightly overvalued range. So Florida and Texas, again, like to your audience, as they may know, are the big booming markets for multifamily and really real estate, this market cycle. And then, of course, all the other Western markets and Southern markets, all the other Western markets as well. But really the big ones, where all big multifamily investors go. And but they were not super overvalued. They were like 8 to 10%. And this percentage every quarter, it moves a little bit, but it's really in this range. And so in the second and third quarter of 2021, these numbers kind of doubled. And at the end of 2020, the only sharply overvalued state that I was seeing in this analysis was the state of Idaho at 25% overvalued. And I was going to different events, and I was speaking about Boise in Idaho being, the most overvalued city in the country. And so Idaho was kind of the only, sort of in bubble territory code. And so Idaho jumped from 25 up to like 47% overvalued at the end of quarter 3 of last year. But again, it's the majority of states are not overvalued. They're in fact, if we take the Midwest and Northeast, they're even undervalued. And again, being undervalued, this is not an appreciation predictor. It's only a downside predictor. But certain states and markets to the west started to enter bubble territory for the first time last year. So those are the first signs of it. Again, does it mean if we take before 2007, so U.S. real estate was very fairly valued in 2002. Then between 2003 and 2005, over the course of just 2 years, it went to very overvalued. And then the bubble burst in 2007 only. And so it kind of took 4 years since really the first indications of a bubble. So what I did, like at my kind of like educational series, I just shared, okay, now it appears that's at least in my data, the second and third quarter of last year does appear to be the first indications of a bubble, primarily in Western markets. But again, that's just the first indications that, where it just wasn't a bubble before. And so it can take, maybe it's going to take 4 years, maybe it's going to take less, maybe it's going to take more. I do not know. I have no senses for timing, but it's just a measure of downside risk for people to have. It's not, again, like some of those Western markets, and those are really like I would say, so Idaho, Arizona, Nevada, Utah, and Colorado are the 5 states that are, let's say, over 20% overvalued. It seems in this measure, so those are extremely strong markets. Those are markets that are booming. So again, but it just happens to be that they have at this moment now, especially with inflation and that's like where I feel like it's have essentially gone a little bit too much, So it seems relative to their fundamentals. Because one thing to keep in mind about inflation, I feel people talk about, the benefits of inflation to hard assets, and so that is true that the hard assets benefit from inflation. But there is a consideration, though. What if? And that's if asset inflation exceeds wage inflation, then that's going to give you downside risk afterwards.
Right.
And so that's what happened in some of the Western markets in the second and third quarter of 2020, notably Arizona, for example, where the prices appreciated in the first half of the year substantially. At the state level, I believe about 17%. And then incomes increased by just 1% at that time. And again, I hope, I'm actually curious to see how this data evolves. I hope that maybe wage inflation catches up a bit and some of that, kind of wears off or becomes a little bit milder. So I do hope for that. But again, the majority of markets in the States are not overvalued. But there are some to the west and a little bit to the south. The strong markets showed first indication of that last year, and that is what I see. I believe it's statistically valid because, again, like I said, these are measures at the state level. So these are very big land masses. They're very, their price deviations, like I said, above fundamentals were 85% correlated really to the downturns post-global financial crisis. They're not very hard to predict, those big land masses, so to say. Right. It may sound funny, but because they're very fundamental in there. It's much harder to predict a small market. And that's seen in correlation studies as well, and where the county data that we publish at RealtyQuant, it's really the correlation at the county level was was 75%, not 85. So, I mean, 75 still sounds high, but it's actually much worse. You can see it in the data. It's not, it's not so good. So it's much harder to predict small geographies. But yeah, if you have a big state like Florida or Texas or something like that, and it deviates from its fundamentals, and if this deviation over the course of just 1-2 quarters kind of went to double the levels where it was at for a period of 4 years.
Oh, sure.
Yeah, so it kind of like that seemed to be statistically valid. But again, like just to kind of calm people down, since I'm a pretty positive guy myself, but I don't like bringing kind of negative news. It's more like those are extremely strong markets. They're going to continue booming. So if you have like a market like Phoenix in Arizona, I mean, it's going to be booming. There is no question about that. It's just that simultaneously, this kind of measure is going to be your downside risk predictor once the cycle ends, once we reach a peak in the current cycle. And so it's just like a supplementary additional metric on the downside risk. It has no relevance to the appreciation that is still going to continue, even if it's overvalued. And that's what happened before the global financial crisis as well, because markets are autocorrelated, like I mentioned. There is trend. So they will continue. They will continue to boom, but it's a downside exposure to be aware of.
Now, what markets would you say are you talking about those that are inflated at this point? What about markets where great deals could be had, where you can buy things way under value?
Yes. Now, again, like just to clarify, on the undervalued markets, what is, so to say, a deal about them is that they carry very, very little downside risk exposure. So they're almost immune. So like I mentioned, the 10 states which were undervalued before the global financial crisis, they dropped an average of 4%. So we have like an event like the global financial crisis, which is the biggest, really the biggest downturn in U.S. real estate recorded price histories. And so in spite of that, like undervalued states, drop so little. So it's really, that's what is, so to say, a deal about those. It's not that they, in being undervalued, they're going to experience, a stronger appreciation after this. That's not the case. In fact, they are expected to perhaps experience less than some of the more booming markets, which are now overvalued. But it's just that they are more protected. Now, there are certain markets. If we take, for example, the state of Indiana, like if we speak broadly, is one example where prices have had healthy appreciation. So in the state of Indiana, appreciation this market cycle is like about 58%, I believe, since the last fair valuation. So it has experienced healthy appreciation, and nevertheless it is kind of fairly valued now. It's at like plus 4%, but it really fairly valued. So this is one example. It's really places in the Midwest and Northeast. It's markets which are not so strong, Bill. Unfortunately,
right.
That is the current time of the cycle. But there are exceptions. For example, at the beginning of COVID, I spoke about it back then. Denver, Colorado was top 5 booming city by price appreciation, and in fact, Denver was actually fairly valued. Now it already went a bit overvalued, I believe by like 10-12%. But Denver at the time was a booming city, top 5, and nevertheless it was fairly valued. And so that happens. It's just having this kind of extra measure and comparing and so forth. But really at the moment is, let's say, for my own investment, I kind of looked at, since I'm looking at some commercial multifamily myself, and so I'm looking at places like Indiana, Kentucky, Ohio, things like that. And I mean, I'm considering to do like another round of kind of direct to owner campaigns in some of the southern states like Georgia and Florida. It's just that I do have the market valuations and I do track them. So I feel like if I pick a project that has that kind of aims to be like a 2-year hold or something like that, like a quicker thing. It could work, since real estate is not so quick to completely collapse. And even after the global financial crisis, it wasn't that quick. And so it kind of took a long time for prices to really drop. It took about 4 years and a quarter, in fact, for prices to reach to their complete bottom after the global financial crisis. Now, about 25% of that decline happened in the first year. So this is a risk to have. But so again, like for me, it's really, okay, can I have a shorter term play in some of the southern markets, or, in places like Florida and Texas? Or can I, take a longer term position in just places like Indiana and Kentucky, and then really avoid Idaho, Nevada, Utah, Arizona, Colorado altogether?
Right. Well, we're kind of zipping by on our time here. I want to be able to get just a few more things in here. One of the things that, our audience are folks 50 years of age and older. They're some are approaching retirement, some are in retirement. They're looking at real estate investing as a means to help them in their retirement. How could RealtyQuant, how can it help those folks as a resource as they're looking ahead at having real estate be a means to generate additional cash flow?
So how can RealtyQuant help them? You mean, Bill, in this sense? Yes. I think market, like what we had a discussion now in market selection, that's going to be very valuable to them in trying to reach their retirement goals and having downside protection. I think this is extremely useful. We've seen like people who did so well before the global financial crisis then was nearly all their net worth, in fact, after that. And that was some, for some of the very leading real estate investors at the time was true. Since you're levered and you kind of you're kind of stretched like that, and you realize certain equity gain, and then at a downturn, on paper, at some point it could be that you sort of lost it all. And so this is this is a risk, and so I think like having this kind of market selection that is very robust is definitely very helpful. Now, the data-driven techniques, like some of them are like more active and so forth. But I would say if people want to invest, if like some of your audience, they want to invest, that's in commercial assets, and they're more active, one thing that helps a lot is on the data-driven side is utilizing rental listings information, rental listings data. So that's another thing that I've been doing. Like I mentioned, the lead generation at RealtyQuant for commercial. So what it really does is to utilize various data points online in terms of rental information on those assets, on those commercial assets, and try to infer which assets are the ones that have the most value add. So, and that can go like pretty far in terms of not only finding commercial multifamily that is undervalued in terms of its rents, where rents are below market, but also really looking into their other income components, like what fees those buildings are charging, administrative, pet fees, et cetera, as well as what utilities they're charging, what seems to be their occupancy rate, and so this is for more active, I would say, investors over 50 who are looking at the commercial assets. This is a methodology that can benefit them a lot, and so, like I said, like perhaps sometime next week or the week after, there should be live like a lead generation product for that can help them. It's literally going to tell them in like top U.S. markets, like these are some of the commercial buildings that show promise, that show based on their, various data points studied online, those seem to be the buildings that show the most potential to raise their appraisal, to raise their value, which is what a commercial investor is after. And so that is another thing.
That's great. That's great. Wow. And in terms of your business, what excites you about the future of your business and where it's going?
Yeah, so what excites me is, really data-driven developments, building out new models, building out new tools, but also blockchain, really blockchain. So that's, I feel, for your audience as well. That is a direction that I want to take in my own investment, which is a big reason why I started switching to commercial assets entirely. And like I mentioned, like looking for commercial multifamily in Indiana, Kentucky, and other places right now. So it's really blockchain, I believe, is very exciting. The reason is it's not just liquidity. It's also, if we think of the real estate industry as a type of private equity, and we know that in real estate there are deals to be had, so to say, on the passive investor side. So to some of your investors who now would go and they would build relationships with operators and they would invest passively with them, I believe blockchain is going to open doors because it's really decentralized finance, and it's really some of those investments in various operators, sort of mid-range commercial real estate projects, would be tokenized, but not just at the asset level tokenized, which adds a little bit of liquidity to the project because you can sell your tokens at a secondary exchange, etc. But it's really building up the ecosystem of blockchain tokens that perhaps represent various sectors, that may represent the self-storage sector, or the retail or multifamily sectors, etc. And and where that's all private equity, where that can be selected in terms of like selecting very good operators, very good deals, and so forth, where it can be perhaps done better than it's currently done with real estate investment trusts. And I think that is very exciting.
That sounds like it. That's something I definitely want to track. That would be amazing for the passive investors to have that kind of access and, the evaluation tool as well.
Mm-hmm. Absolutely, Bill.
That's great. Well, our time has just zipped by. You had such great stuff to add there. We do this little session at the back end of our shows called Wrap It Up. And I ask you a series of quick questions, and you give me quick answers in terms of resources that have been of value to you. If you're ready, we can go ahead and wrap it up.
Sounds good.
All right. Favorite real estate book?
Favorite real estate book, best ever apartment syndication book.
Oh, it is a great book by Joe Fairless. Yeah. How about just a general business book?
The Richest Man in Bigger Pockets.
Favorite app?
YouTube.
Favorite quote?
It's a long one. We're intellectually the superficial reflection of what we have learned and taught. That's my favorite
And
quote.
who gave that quote?
It's a secret. Somebody
okay.
else.
Okay. I hope we will be able to copy it. Exactly. And final question, if you lost all your assets and you had to rebuild your business and you only had $1,000 in cash, what would you do with that $1,000 to relaunch your business?
Well, I would use my investment manager knowledge and use other people's money.
There you go. Use the $1,000 to take those guys to lunch, right?
Yep.
All right. Well, man, this has been great. Sorry we had to zip on. We're backed up against another hour here, and we have interviews all day here. It's a little crazy, so sorry about that. But how can people reach you and find out more about you and your services you provide?
Yeah, so they can reach me at www.RealtyQuant.com. I also have a YouTube channel, Finance Meets Real Estate on YouTube.
Excellent. Well, Stefan, this has been great. We have a tradition here for our guests that we are called the Old Dogs REI Network. So we like our guests to close us out with their best old hound dog, sort of wolf howl. Okay. You're from Hungary, they have all kinds of wolves and stuff, right?
Yeah.
So go ahead and give us your best howl.
Woohoo.
Okay. That's great. Well, thank you again, Stefan. It has been great talking to you. Some good information and a great resource. I am going to be all over that site, especially with some of the market stuff you were mentioning as well. I think it sounds like a great resource.
Great talking to you as well. Thank you, Bill.
All right. You take care. All right. Bye-bye.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.